Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed with an hour to go in the trading day. Taking a look at the major averages, you're looking at the Dow off just around 81 points, well off obviously the lows of the day. As you can see that we touched not too long after the open. We got that much better than expected number on retail sales. That of course is having an impact on the market's direction today. S&P also a bit under pressure here just in terms of how investors are looking at that retail sales number and what that might mean for Fed policy here on out. Nasdaq, though, holding on to gains up just about 0.5%. Taking a look at the bond market action, 10-year yield pushing to the upside here, up just about 5 basis points at 382. And taking a look at the dollar index, once again pushing to the upside here, just below 104. Taking a look at some of the sector action this afternoon, I mentioned the fact that the Nasdaq is outperforming. You can see that reflected in some of the sector outperformance here. Communication services up just about 0.6%. Consumer discretionary leading the way today. You have technology holding on to gains. On the flip side, you have energy under pressure, off just about 2%. Healthcare also an underperformer in today's market. Inside the Nasdaq, as we take a look at some of the outperformers in the market, you still have Apple up just about 1%. We'll get to the latest story there just in terms of a journal article about a Justice Department probe deeper into the tech giant, what that could mean for the company going forward. But Apple holding on to gains despite that. Airbnb certainly a standout, reported after the bell yesterday afternoon, better than expected earnings. We're seeing that reflected in the stock move today, up nearly 14%. So again, a bit of a mixed picture here, Dave, but Apple, Amazon, Google among the outperformers when we take into account those larger cap tech names.
Yeah, and it's interesting. They've had such a strong start to the year, despite, you mentioned the DOJ, there's the FTC, the Biden administration across the board really looking like they're going after big tech and not relenting. Shauna, thank you. All right, let's get you up to speed now on retail sales. Those numbers coming in higher than expected today. Sales jumping 3% in January. This is the biggest monthly jump since March 2021. What was happening then? Well, we just got a fresh round of stimulus checks, so that's why that number was huge. Why this one is? Well, let's ask Brad McMillan, Commonwealth Financial Network CIO, joins us now for more on the retail state of the consumer. Good to see you, sir. So I mentioned biggest jump since we got that fresh round of COVID stimulus checks. We had a really tough number in December. What do you make of this one?
At the end of last year, we had an awful lot of worry about a recession that was coming. You know, we had the recession, we had the Fed raising rates, and there was a real fear out there that it was going to knock things off. But then we've seen job growth continue. We've seen consumer confidence actually come back. And that recession that we were going to get doesn't seem as likely, certainly not in the short term. And people are saying, you know what? I've still got a job. I'm still making money. They're going out and spending. And not only that, they're trying to catch up a little bit from the end of last year. People pulled back and now they're saying, you know what, we're okay and we're going to go spend. And that's what we saw.
We certainly did see that, Brad. Nearly every category saw a rise in sales. Car dealerships, furniture sellers, electronics among those top increases. When you take into account the large jump that we did just see last month, do you think that momentum is then going to continue given the fact that the labor market, like you've just been saying, has been so resilient?
I do think we're on a momentum trade here. And the thing that really struck me, Shauna, about the numbers that came out, it's not just that sales were good. It's that sales were good in big ticket items, in cars and furniture. In other words, people were willing to pay up for things that really would make their lives better going forward. And the other thing was going out for entertainment. So all of a sudden you have a consumer that's willing to make big ticket purchases. You've got a consumer that's willing to go out and have a good time. And that doesn't say to me a consumer that things are going to get bad in the near future. They're going to keep feeling good. And I think the spending is going to continue.
Boy, one number that stood out to me, and I'm still trying to figure out if it's possible, department stores saw a 17.5% bump in January. That is enormous. But Brad, what's the Fed side of this? How does Jerome Powell see this number when you take into account what we did see in those jobs numbers recently?
I think this is one more piece of evidence that Powell is going to look at it and say, you know what? I was right. I was right to say we need to keep raising rates. I was right to say the economy is still growing. I was right to say that inflation is going to keep going up. And I think this validates pretty much everything that he's been saying. And I think it significantly increases the chance of a rate increase, not just for the next meeting, but certainly for a couple of meetings after that. We're not seeing the pullback that he wants to see. We're not seeing the pullback that everyone thought we were going to see. Instead, we're seeing something that looks an awful lot like the economy starting to grow again. We've gone from bad vibes to good data. And again, that says to me there's some strength here.
So, Brad, then how high do you eventually see rates getting?
Well, there's been a lot of talk about going to 5. I think the Fed has been very clear. We're going to keep raising rates as much as we need to. And there's even some loose talk out there about 6%. I would look at it a little bit differently, though. I mean, the real story about the rate increases is not that they're happening. It's that they haven't really slowed the economy that much at all. If Powell is looking to increase rates, to slow the economy, and that's not happening, I think we have to take seriously that they're going to be data dependent. So I'm not sure that there is a lid on this, but I do think the Fed is going to be careful simply because we've got, extensive rate increases that maybe haven't yet hit the system. So I think we're going to continue to see slow but measured rate increases. And they're going to tiptoe up to the edge. But I think at this point, the ceiling is higher than we thought.
Yeah, the JP Morgan CFO earlier this week said 5.5 as a terminal rate. So the talk has gone from hard landing to soft landing to now we're in this discussion about a no landing, which to me, I guess I'm just on a plane forever. What does that mean economically speaking?
Well, if you're talking about what it means to the average person, it's a good thing because that means we're not going to get the recession that everyone's been scared about, at least not for a good while. And what's interesting to me about this particularly is not so much, are we going to have a recession this year or next? I've always thought it was going to be a very soft recession if we got one at all. It's that the economy is more resilient, and that means that we've got more room to grow going forward. It also means that the economy is now able to survive higher rates. And that's actually a really good sign because it means that fixed income investors can keep getting decent yields. Stock investors can look at that and the valuations are holding up. In other words, the markets are more resilient. So as earnings go up, as the economy continues to grow, there's probably more upside ahead.
So, Brad, if there is more upside ahead, if you're saying that this is good news then for investors, how should investors be positioned for that type of scenario?
Well, if you're already fully invested, then I think it makes sense to stick with your asset allocation. And certainly, as I say, with higher interest rates, fixed income is more attractive than it's been in a long time. Depending on what your needs are, you can actually take a much, much lower risk stance than you have in the past. So I think at this point, if you're in a decumulation phase, you want to consider de-risking if you can meet your needs. On the other hand,
sorry, Brad, go ahead.
If on the other hand, you're still accumulating and you want to grow, now is the time to maybe think about taking more risk.
Certainly a lot to consider there. Brad McMillan, always great to get your perspective. Thanks so much for joining us. We also want to get you up to speed on Apple shares higher today, despite a journal report that the Justice Department is escalating its probe into the tech giant. Yahoo Finance senior tech reporter Dan Halley is here with the latest. Dan, the pressure is certainly on tech from the regulators' perspective. What's the latest here?
Yeah, this is basically kind of just a discussion about how the DOJ seems to be getting further along in its investigation into Apple. We've heard about this seemingly since, forever. For the past at least 2 years, we've been discussing it. 3 years, 4 years, there's been a probe going on. And really, what they're talking about here is what Apple does as far as its ecosystem and blocking out third parties. We had previously discussed the App Store, and this seems to be more about the technologies that Apple allows others to access on its devices. So one of the instances that's discussed is Tile and the tracking ability that offers. Apple offers its own tracker, and so Tile seems to argue that, look, Apple's cutting us off from certain features. It asks if it wants Tile to track them all the time. That makes people feel a little leery of it, where with Apple, it doesn't ask you if you want a AirTag to track you all the time. So there's these issues that are, kind of across the spectrum where Apple seems to favor its own devices, whether it's, with the ability for instant pairing with your AirPods or your Apple Watch or something along those lines. With other apps, you don't necessarily have that ability. The ability to access the wallet and use things like Apple Pay. These are different features that Apple offers that third parties are saying, look, they're blocking us out and hurting us as a result. Now, Apple, on the other hand, would tell you, hey, these are the features that we offer to ensure that people want to keep coming back to us. So it's this, is it too much of blocking out third parties, or is it just Apple offering features that makes their products seem more attractive?
Interesting to check on investor reaction, which is none. The stock is up more than 1% today, up more than 20% this year. And that's with many feeling that the Biden's crackdown on those junk fees would also hurt Apple's App Store model. These two things taken into account, what is the impact on the App Store?
Yeah, so, the App Store has also been discussed a lot as far as antitrust goes. That 30% or 15% fee that they charge other developers. The problem is this seems like it might be going, away to a degree. There's in the UK, they have the Digital Markets Act, the EU, they have the Digital Markets Act. And what that essentially does is says, look, you have to open up your device to allow third-party app stores. Now, if you are being charged a 30% premium on Apple's App Store, and there's a third-party app store that you can access, a lot of people might go to that cheaper option for that third-party app store. So they're expected to roll something like that out sometime around 2024 when the enforcement of that goes into effect. But it really could make Apple change its ways as far as whether or not it's going to offer the third-party app stores or not.
And Dave, if we do in fact see a lawsuit, any idea just about the timing of that?
It could still be quite a ways away. I mean, like I said, we've been tracking this for years now, and so we haven't had anything come down just yet, but this just proves that they're really ratcheting it up and something is likely coming.
Yeah, when you factor in the FTC, Amazon, Microsoft, Google, and Apple all under some form of investigation by the administration, that is an unmistakable and massive trend that is not impacting the stock.
I was going to say, and there's been no reflection of that in share price. I mean, take a look at Apple, up about 1% today, up over 20% since the start of the year. You can see that for a lot of those tech names. All right, Dan Halley, thanks so much. Well, we are just getting started here on Yahoo Finance Live. Coming up, a travel takeover. Okta founder and CEO Todd McKinnon joining us to tell us why travel was the #1 fastest growing app category for the business this year. Then we will speak to Shark Tank star Barbara Corcoran on whether or not she thinks the housing market is going to bounce back this year. An earnings season continuing. Cisco, Shopify reporting after the bell. We'll bring you those numbers as soon as they're released.
Do we work from home or live at work? That's one of the key questions to come out of a new report from Okta on business at work. We are thrilled to discuss that report and what it means for businesses today with Okta CEO Todd McKinnon and senior tech reporter Ali Garfinkel. Nice to see you, sir. Let's start with that statement. Explain where that comes from and what it means for businesses today.
Well, first of all, thank you for having me. This is our 9th annual Businesses at Work report. Okta, as an identity company, we sit between employees and customers and all the digital technology they use at work or in their personal lives. So we gather unique insight about who's using what and what trends are shaping the technology industry. And we publish it in this report in this aggregate format to give the industry and the public a view into what's going on in technology. And the many interesting things this year in the 9th report. But one of the most interesting things is that people are mixing work with their personal lives. We see applications like Strava and MyFitnessPal and Venmo and PayPal. You're working, you're spending money, you're doing wellness like Modern Health, and you're doing it all together as you work in this hybrid world we've all been working and living in for the last several years.
Hi, Todd. Ali here. One of the things I want to actually specifically talk about that personal finance piece. The statistic that really stood out to me from this report was that apps like PayPal and Venmo, which were built for personal finance, have seen growth of more than 20% year over year in corporate settings. I was surprised, honestly, because my first thought was, does that pose a security risk? How should we be thinking about this? And frankly, is it something you would allow on Okta's corporate network?
Well, it's a really interesting question. There's always this balance between what an employee does for their specific work tasks, and then what they might be doing during work time for their personal lives. And in this data, you see the usage of these apps, and it's pretty hard to tease apart what they're actually paying for with these apps. Is it work tasks or is it personal tasks? But I think many companies are being more flexible and trusting employees to do the right thing and to take advantage and use the tools at their disposal to do the right thing for work. And if they need to do some personal things on work time, that's okay as well. This is part of this flexible hybrid world we live in. And Okta, at our company, we behave the same way. We trust our employees to do the right thing and give them the best tools, and they do a good job going about their business in that way.
Report that you point out that's really striking is that Microsoft has been losing out to AWS in both single and multi-cloud. What's behind that from your perspective?
Well, one of the interesting things from the report, in addition to the personal apps and work apps and this mix of work-life balance, is that companies in these times of economic uncertainty and tightening, they're really investing in technology. So we see in our report the average large company over 2,000 employees is using over 200 applications. So 211 applications on average, to be precise. And they're investing more and more in the number of applications. That number has increased, almost doubled over the last several years. So through the times of COVID and now economic uncertainty, CEOs and CTOs and digital officers are doubling down on technology. They're also doubling down on security. So we saw a market increase in the amount of security tools that were deployed around this technology. Every company has a strategy for something called zero trust, which is basically mean support this hybrid work from home environment in a secure way. And the number of tools around zero trust has grown 20% in the last year. And this gets back to Microsoft. So the Microsoft pitch is that buy everything from Microsoft, from this monolithic platform, and they'll do it all for you. And that's a good pitch, but when you look at the data, first of all, in an important category like cloud infrastructure, AWS is far ahead. They have 8 times as many customers, growing very quickly. And then in the core communication and collaboration apps, you see half of Microsoft customers also use Zoom, and about a third of them also use Slack. So you're seeing many of them supplement Office 365 core email with all of these best-of-breed collaboration apps and best-of-breed security apps to make it all secure and make it all manageable.
Todd, also stand out in this report among the most popular apps, you saw a stunning rise in travel apps. Clearly the popularity of them soaring here throughout this past year. How big of a jump are we talking, and how do you see this trend playing out?
Well, it makes intuitive sense. You think about your company and different companies. More companies are getting back to normal business travel. In fact, Morgan Stanley has a report out that says about a third of companies anticipate in the next year normal business travel levels. And you're seeing this in our data as well. You're seeing travel apps. There's a travel app called Naven, which it used to be called Trip Actions, but it's one of the fastest in the category of apps, travel apps overall, which grew very rapidly, about over 20% growth in that category. And Naven is an app that lets people book travel and do corporate expenses. That grew almost 100% year over year. So it kind of jives with the data that companies are getting back to traveling, and they're using the applications that make that happen.
Todd, one more from me. I want to actually dive into a little bit more on this travel data, Naven in particular. Where is this growth coming from? Do we know where people are going? Is there any kind of color we can give us into that major growth number? Because it's a big number, but I feel like I don't know what it means.
Yeah, I think it means that it's very broad-based. So different kind of industries, different different sizes of company. In our data, we have over 17,000 companies as customers across all industries, all segments, all geographies. And in our integration network, so the number of applications that are integrated to Okta, by far it's the leading in the industry. It's over 7,000 types of applications. So when you see a jump in a horizontal category like travel and the growth we're seeing with Naven, it's what we know is it's very broad across industries and sectors.
Okay, Todd McKinnon, Ali Garfinkel, great to have you both. Really appreciate that conversation. Coming up, shares of Bed Bath & Beyond are falling after Citi downgraded the retailer. We'll tell you why the analyst is bearish on the other side of the break.
It's time for Triple Play. 3 stocks that we're watching in the final 30 minutes of trading. We have Bath & Body Works, DraftKings, and Roblox. Kicking off with my play, it's Bath & Body Works. Citi downgrading the retailer to neutral because it's worried about margins, and here's why. Those higher raw material costs and also elevated wages are expected to pressure results here going forward, at least in the short term. Citi, though, does see CEO Gina Boswell focusing on cost cutting to offset some of that margin pressure, but the move is, quote, going to take some time. Earlier this week, Deutsche Bank, on the other hand, raised its price target on the stock to $55 a share, reiterated its buy rating, making the case that it sees, quote, a path for multiple expansion as the company looks to, quote, improve profitability. So some mixed views here on Bath & Body Works ahead of their earnings that we're getting here pretty soon. But certainly the retail sector, lots of questions just about what exactly that's going to look like. We just got that very strong retail sales number out this morning. Before that, there's lots of talk about a looming recession. So I don't know.
15 buys, 6 holds on the street on the stock, and it's no sells though. So it doesn't seem like anyone's overly actually bearish on the name itself, but it's basically, it seems like a little bit of a wait and see until we get earnings coming up here in the next few weeks to sort of see what they're going to do with those margins, Dave, and sort of what happens there. I know we were joking about it in the break, but it is kind of funny with Bed Bath & Beyond because they do sell some similar products. And then you think about all these headwinds coming at potentially Bath & Body Works and how that would impact a company like Bed Bath & Beyond and others in the retail sector.
It feels like it awaits a very similar fate. I hate to say that, but it does feel like something that was just much more relevant in our lives 20 years ago, and it's just a matter of when, not if. But Dan Loeb, third point, we've talked about how many companies face pressure from activists. Dan Loeb's third point owns 6%. Hinting they might push for board seats, closely watching the company and its new CEO among the many companies out there facing outside pressure.
Activist Investor Watch, Dave, one of our favorite stories.
Hashtag, man, yeah, that is the trend of the year.
Always coming up. All right, but my play today is DraftKings. The stock in the green today as the American Gaming Association releases its full year revenue report for 2022. The headline, sports gambling racked in $7.5 billion in gross gaming revenue last year. That's nearly double the number from 2021. Overall gross gaming revenue for the industry hitting a new high as well, breaching $60 billion for the first time. Now the other casino names, MGM, Caesars, not taking much of a leg higher on this news. We already heard revenue numbers from them for the quarter, guys, so not surprised to see that. But I do think it's interesting to point out that massive number, Dave, when we talk about sports gambling, and we know that top line is growing for DraftKings, but we have earnings coming for them after the bell on Thursday, and people really want to know where are they for profitability and what are they going to guide for the full year? What is the commentary going to be from Jason Robbins? So a good day for the stock today, but I do think it's going to be interesting come Thursday and that call Friday morning to hear sort of what the overall outlook is. They think they'll have a profitable quarter this year. Yeah. What's the big picture there?
What is the road there? And pushing it a little more forward to Q1 results for Caesars. William Hill was one of the big losers on the Super Bowl. Not widely reported, but had a massive outage on their sports gambling app in the second quarter, lasted throughout the game and did, according to reports, impact Caesars, and it will likely impact their Q1 results, pushing more forward to next year when we really get a sense of it because the Super Bowl is in Vegas, guys. And one analyst says 200 million in wagers expected in Vegas alone next year as they host the Super Bowl. That will be a gambling extravaganza. All these companies seeming to benefit.
Yeah, certainly. And I think when it comes to DraftKings later this week, when we do get those earnings reports, lots of a focus obviously on profitability, like you were talking about. Also just the amount though that they have spent on ads and what their plan is going forward. We know that has been such a large topic here of recent quarters. They were pulling that back. What exactly that landscape looks like going forward as they do hope to grow and capture and reach those astonishing numbers that you were just talking about.
We're going next year.
I would love to go.
Okay,
you
Josh is in.
Did you say 200 million bets?
200 million.
All right, we can each do like 5, so we can add to that. We can contribute a little bit.
And I'll lose all my money.
The 3 of us would like to be there, just saying. My play is Roblox heading towards its best day in more than a year after a solid earnings report. Bookings topping expectations, clocking it at 899 million. Chief Financial Officer Michael Guthrie said on the company's earnings release, quote, growth was strong across all geographies and age groups, with particular strength among users above 17 years old. Their CEO added some more context on that on the earnings call that January bookings among the 17 to 24-year-old age group rose 39% from a year before. Check out the 5-year chart. Really shows you the roller coaster ride that shares have been on for Roblox. $134 stock in November of 21 to $26 a share in late December, and now right back up 60% to start this year. It has been a wild ride, aging up being the key right now.
Yeah, and aging up makes a lot of sense. They need to grow their user base. They're doing all they can in order to do that. We know this past quarter, the holiday quarter, was very, very important for Roblox. So those impressive numbers, that's why we're seeing such a pop in the stock today. We're seeing the best intraday gain that we have seen in Roblox in just about 9 months. Talking even more about some of those numbers, 13.4 million people are now paying for in-game content. That is huge when you're talking about expanding that consumer base. It was the most that they've added in terms of new players paying since the pandemic. So certainly they needed to do all they can to grow that user base like you're talking about. Going for the older folks makes a lot of sense. They have more money to spend.
Thankfully, we have a younger folk.
But
I fit into that age range. I fit into the age
and
range.
what they were talking
I would be in the
about.
older age range of what 17 to 30, right?
Mm-hmm.
So I fit into that kind of middle age range of I'm not necessarily a younger video game player. I know we have several talent that we deal with on our shows that their kids play Roblox, and it's a younger age group thing. So it is interesting to see it sort of age up there. And the last thing I'll add, it's just refreshing to see that stock move up on fundamentals like that, because Dave was pointing to that 5-year chart. Remember, this was a metaverse kind of stock that we were talking about for a while. People were interested in it because it was they had that metaverse angle, and that was part of what brought it up so high a couple years ago. Now you're seeing it start to move more fundamental on earnings, on fresh bookings, growth that way.
Have you played?
I have not played Roblox.
Have you?
I'm not in that.
I don't even
not in that age
know.
group. Your kids? No?
Nope.
All right, well, we got to give it a
gotta
go.
test it out.
They're
gotta
they're
test
trying
it
to get us all on board. All right. Well, coming up next, home builder optimism spiking this month. What is the worst of the housing market crash behind us here? We will speak to Shark Tank investor Barbara Corcoran about what lies ahead for the real estate market. She joins us right after the break. Don't go anywhere.
A sudden burst of optimism on the housing front today as we saw the largest monthly gain in a decade when it comes to confidence in the newly built single-family home market. The National Association of Home Builders Index rising 7 points to 42. Let's talk about the housing market and the boost of business creation, among other things. Joining us now is Shark Tank investor Barbara Corcoran, host of the Business Unusual podcast, founder of the Corcoran Group. Barbara, always wonderful to see you. Let's start with the trillion-dollar question. Is the worst behind us in the housing market? What are you seeing out there?
I think the worst is behind us because the housing market is showing signs of life for the first time in the last year. Everybody believes, whether it's true or not, that the Fed is done lifting rates. And with that, it's ushered a few more buyers into the marketplace. But when you think about it, the average price that we paid a while ago is not very different than we're paying 1 year later. I think the price now is $366,000, which is only 2% up from a year ago. But to pay for that house with the higher interest rates, the home buyer has to pay another $600 a month. Think about that. That's what slowed down the housing market, mostly the interest rates. The big problems still are high interest rates, and there's still a lack of inventory.
Yeah, so Barbara, that leads me then to, yes, we are starting to see signs of life, like you said, in the housing market. What's it going to take for the housing market to take off? When you talk about that mortgage rate number, what does that need to fall to in order to really see a huge boost in activity?
It's going to have to drop 2 points, and people are going to act like there's a sale on. Anybody who even has the first thought of buying a house is going to rush the market, and then we're going to have house prices go through the roof again, as we saw 2 years ago.
So real estate agents are currently having a tough time, no question about that, with sales and inventory where they are. One of the new tools they have at their exposure is ChatGPT. We're told many of them are using it to write listings, even legal documents. But Elon Musk, who co-founded OpenAI today, called it one of the biggest risks to civilization today. How are your agents using ChatGPT, and how can it be a game changer in real estate?
It's not just agents in real estate. Everybody's using it. If you have a low IQ, suddenly you could look smart. The same kind of documents you had to review that would take an hour, you see in 2-3 minutes. People are writing emails and text and explanatives of the market to their customers. It's like the whole world got a genius implant. This thing is such a game changer. I'm sure it's not just limited to real estate, but boy, is it helping us.
Barbara, you certainly have a pulse on what's going on right here in New York City. Give us a sense of the demand picture right now in New York City. And we were just looking at your site not too long ago. There's a townhouse on sale right now for $80 million. It's up on your website. It's on Fifth Avenue, prime real estate, Upper East Side, 8 beds, 10 baths, around 20,000 square feet. Do you think there's a buyer out there for that?
I think it's going to be a hard buyer to find. You know, it's owned by the richest man in Mexico. He bought it 10 years ago. I think it was for $44 million, and he's almost doubled the price and hoping to get that. He's not going to get that. He's going to get about 40, if he's lucky, 45 million, which doesn't even cover the commission. I probably shouldn't say that. The reason being, there are half a dozen houses just like it on the marketplace that are not selling. And the reason they're not selling is not so much that most of them are overpriced, but the problem is people don't want to do gut renovations of old mansions anymore. It's asking too much. It costs too much money. And the foreigners aren't buying them. The Wall Street has had a rough year last year, so they're not buying them. So the million-dollar question is, who's going to pay that $80 million for that house and all the other houses on the market? They're just sitting.
Yeah, we saw a lot of wealth leave New York, and in particular, take it down to Florida, where suddenly 9 of the most expensive 12 zip codes in the country now exist in the state of Florida. How much are you seeing that exodus of wealth in New York?
Well, it's new money and old money, but held by older people that are going down to Florida. And I would have said that was generally what was happening until 2 years ago. And now we see an exodus of a lot of young people who are taking their wealth and bringing it down to Florida. It's an exodus of wealth and taxes to the city. So I don't know what's going to happen, but there's been a bellwether change. All
right, we want you to take off your real estate cap and put on the Shark Tank cap. Fascinating numbers in terms of business creation in this country. More than 5 million new businesses were created in 2022. That's an increase of 44%. Really a staggering statistic coming out of COVID. Do you have any sense of what's behind that and what types of businesses are being created?
Well, you've got businesses being created in every sector. So there's no difference than there was 10 years ago, but the quantity is what the game changer is. Everybody wants to be an entrepreneur today. They had time to sit home and think that they really don't like their job and they really don't want to answer to their boss. And they think the golden ticket is to start your own business. But the real question is, how many of these people are going to succeed? It's not easy to build a business. It's a great time to build a business because there's so much uncertainty and concern. So people are open-minded to new ideas and new concepts. But to actually succeed in business takes a certain type of person. And most of the people who are opening their shops are not that type of individual, which is they have to have tremendous enthusiasm, a phenomenal work ethic, and more than anything else, they have to be aggressive. And a lot of people mix up starting a business with enjoying a hobby. So we're going to have to wait and see how they go. But how great is it that people are taking their own life into their hands and deciding to take control and start their own business? That's the best news of all.
It certainly is great news, and it really is a stunning number given where we are in this economic cycle right now. Barbara, when we talk about what keeps workers maybe at larger companies, those that aren't leaving to start their own, it's been interesting to see more and more companies are bringing their workers back to the workplace. The latest data out here from Castle Systems, which tracks badge swipes, is saying that about half of workers are back in the office at least a couple days a week. What is your advice to those people? Because we know a lot of workers are upset. They don't want to return to the office. What do employers need to do to keep those employees happy?
Well, my advice would be more to the employer, the boss. The fact of the matter is they're not in charge anymore. The employees are. And the quicker they realize that, the better they are going to be able to run their businesses. If you go into anywhere in Midtown Manhattan or downtown in Wall Street, you find that Fridays are dead. Mondays are just a crapshoot whether anybody comes in. Even when they offer free dinners and lunches and parties, people still aren't coming in. And when foot traffic is down, people don't go to the restaurants. They don't go to the bars after work. The whole economy suffers. The city is suffering. They're losing so much money in sales revenue because of the worker taking control and saying, I don't want to go in. And if you look at the biggest companies here in our town, in New York City, those buildings are half empty. They're half empty. And in fact, recently, I've been watching on the real estate front that the new leases are being negotiated for a percentage of their, the rent is being negotiated for a percentage of their sales. I've never seen that before. I never thought that would happen. So what remains to be seen is, are the bosses going to realize they're not in charge? The employee is in charge. I don't think it's going to change much.
We hope you're right. All right, let's put on that third cap. Business Unusual podcast host. Quick game, quick answers. Trend or trademark? First up, quiet quitting. Is it a trend or would you trademark it?
It's over. It was a trend. You know what's happening is the guy who's sleeping at his desk, the boss is really looking at them, or even if they're at home, they're looking at them. They're not going to keep their job. You better get over that.
Barbara, what about canned cocktails, CBD cocktails? Certainly have seen a rise in both as of lately. More and more companies pushing into these categories. What do you think?
It's a trend. It's just getting started. People love to drink them. It's healthier than a can of beer and makes you feel happy. What's wrong with that? And you could drink it and act like you have a can of soda.
Pickleball. All right, how about pickleball? Trend or would you trademark it? We hear about pickleball every day.
Well, it used to be for grannies and grandpas, right? But they got their grandchildren playing, and now everybody is playing it. So I would say trademark that one.
And Barbara, we know that you're very fashionable, so weigh in on one of the biggest hits coming out of Fashion Week this week. Mischief sneakers, boots, these massive red boots. I don't know if you've gotten a chance to look at these yet, but they're huge. They look like they should really belong to some sort of cartoon character.
Actually, they look to me like they belong on Mickey Mouse. So if you're into Mickey Mouse, great idea. But if not, it's a trend, and it will last about a week. They look like they weigh 50 pounds to my eye.
They look uncomfortable, that's for sure.
I am with you on that. Barbara Corcoran, always a pleasure. Thanks so much for being with us on Yahoo Finance.
Thank you very much.
All right, coming up, we break down what ETF flows are telling us about where investors are putting their money this year. Stay with us.
$61 billion has entered the ETF market since the beginning of the year. So let's talk about what flows could look like for the remainder of this year. We want to bring in Tom Lydon. He's VettaFi's vice chair for this week's ETF report, brought to you by Invesco QQQ. Tom, it's great to see you here. So certainly $61 billion has flowed into the ETF market since January 1st. What does that signal to you just in terms of the demand that you're expected to see going forward?
Well, we had the second biggest year in flows last year, over $600 billion, and it's off to a good start, Shauna, but it's telling us something completely different. On the equity side, most of it was U.S. flows last year. This year, so far, 5 times as much money has gone into international ETFs, developed markets and emerging markets, and all for the right reasons. Valuations are a lot less expensive, almost 20 to 30% less on a PE side. And when you look at emerging markets, in some areas, single-digit PEs, where we're seeing 17 PE here in the U.S. So people are looking at opportunities. They're also looking at the pendulum kind of swinging back towards a little bit of love for some of those unloved areas.
What are some of those areas, and what are some specific funds that would allow you to take advantage of that?
Well, a couple of the ETFs that have gotten the most flows so far this year is the JP Morgan Beta Builders Europe ETF, ticker symbol BBEU, and then the iShares Core MSCI Emerging Market ETF, one of the best emerging market ETFs out there at a very inexpensive price, IEMG. Those are some that are getting collectively almost $8 billion so far this year, David.
Tom, what are you hearing from advisors just in terms of the mixed data that we are getting? Lots of talk about a looming recession, yet time in and time out, it seems like we keep getting these econ data numbers that are very, very impressive. How is that influencing the thinking right now on the street?
So great question. We're surveying advisors all the time at VettaFi. They are feeling like the Fed's got this inflation thing under control, which is good, although they've baked in a couple more rate hikes. At the same time, they know they can't top tick rate hikes. So what they're doing is pushing longer duration, lower credit quality, trying to grab more longer term exposure as far as yield. And they know that this is not going to happen forever. So they're grabbing it while they can. A couple of the ETFs they like on the fixed income side are the iShares Investment Grade Corporate LQD, and also the iShares 20-plus year Treasury ETF, TLT. Again, longer duration, lower credit quality as far as the corporates, and high yields are also seeing some opportunities too.
Tom, we're always trying to play the trends, and we would go back, 6 months or so, there was talk about a hard landing, a tough recession, and then it kind of shifted to a soft landing. We'd be okay, but maybe a mild one. Suddenly, the new talk is shifted to no landing, no recession, just keep on sailing. How do you invest in that strategy?
Well, number one, you want to make sure you're invested. A lot of people have taken money off the table the last year or two. Having cash has actually felt pretty good, and now you can actually get paid for it. So that's been great. I think what a lot of advisors are saying is don't operate on your stomach, make sure you're allocated, and it may be that the S&P is not the place to be. You look at compared to 4 months ago off of the low, the S&P is actually the worst performing area of the market compared to the Nasdaq 100 that was up 17% since then. The S&P equal weight, it was up 19% compared to the S&P being up 15%, and then small cap has almost trumped them all, not only since the low, but also so far this year. A lot of people have not loved that area of the market, but if you look for international opportunities, one opportunity is the iShares Europe ETF IEV, up 30% in the last 4 months. There's a lot of good opportunity there to take advantage of. The big thing is be diversified. We've had a home country bias, and we've had way more invested in the S&P 500 than should be from a diversification standpoint.
Important points there. Tom Lydon, great to have you. Thanks so much.
Thanks, guys.
Just about 9 minutes to go until the closing bell. Taking a look at the major averages, the Dow still in negative territory, off just about 2 points, just below the flat line. S&P and Nasdaq, though, holding on to gains. We'll be right back. Here we are in the final minutes of the trading. The Dow just below the flat line, off just about 15 points. S&P and Nasdaq, though, holding on to gains. We're seeing the Nasdaq, the outperformer of the day, up just about 0.6 of a percentage point. Airbnb, one of the standouts within the Nasdaq today, following that better than expected earnings report after the bell. We also got a note out from Barclays, bullish calls on Tesla, on Rivian, adding to some of the excitement in the Nasdaq here this afternoon. 10-year yields also moving to the upside. We had the 10-year yield hitting the highest level of the year, and that boost coming following that hotter than expected, stronger than expected retail sales jump that we got this morning. Coming up, we are counting down to the closing bell on Wall Street. More on the markets when we come back.
All right, just a couple of minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery, who has a look at some of the biggest winners and losers from today's slate of earnings releases. Hello, my friend.
Hello there. Just wanted to point out first, Nasdaq really outperforming today, Dow barely in positive territory. This has been what's happening for the year. But as you mentioned, Dave, let's check out some earnings stories here. I'm going to sort by performance. Now, we got some winners and some losers. This is only one day performance. TTT, that's a Trade Desk, that's up over 30%. Roblox on its heels, Airbnb up 13%. Some of the losers, Akamai, Devon Energy, and Biogen. But let me show you what's happened this year, because it's almost a reverse of this. Some of the biggest, or it's actually very reflective of what's going on here. So we see Airbnb, that's up 60%, Roblox up almost as much, Trade Desk up over 45%. But take a look at some of these charts here. Let's start with Airbnb, up 60%. Take a look at what's happened over the last year. Now, a lot of these stocks have broken finally to the upside. They've basically been consolidating. We did get this new low about a month ago, but we have rocketed through resistance here. And you take a look at another pandemic early favorite. This was an IPO that came during the pandemic. This is also breaking, but it hasn't exceeded its highs here. And I'll also throw grow in Trade Desk, as I mentioned, the advertising platform. Now, I think this is significant because it is reflective of more of the economy that suffered over the last year that has to do with advertising and businesses. We'll have to see if that comes back. Now, before we go here, let me just show you what's happening in the sector action for today. Guess what? That's year to date. So let's take it down to intraday. Consumer discretionary, that is up 1%, followed by communication services, utilities, industrials, and materials and tech. All of those outperforming on the top line. Only energy and healthcare in the red. Here's your closing bell.
All right, that does it for today's trading day. As we get the gavel there, Dow, S&P, and Nasdaq all ending to the upside. The Nasdaq, the outperformer, up just about 1%. You're looking at the S&P up about 0.3%. Let's get to some of the top stories of the day. Up first, Marriott saying business travel is back despite continued corporate layoffs. The company's CEO, Anthony Capuano, sitting down with Brian Sozzi earlier today. Here's what he had to say about the growth that we're seeing in business travel.
So group was probably the most pleasant surprise in the quarter's performance.
Pleasant surprise.
Group business was up 10%, and there was some question, well, is that starting to wane? If you look at what we have on the books for 2023, we're actually pacing about 20% up.
Is it conventions?
It's small meetings, it's conventions, even companies that have ratcheted back their more traditional transient business travel, they still feel the need to get their teams together. And so you're seeing a lot of corporate meetings.
Seeing a lot of corporate meetings, Dave. One of the themes that we've been hearing throughout this earnings season is the fact that companies are cutting costs. They're doing it through layoffs. They're doing it through other initiatives. Despite all that, though, they're still sending the employees they have on the road again.
It has been the most stunning revelation from any earnings call for me throughout this entire session, because Tony on the earnings call said he's seeing business travel return to 90% of pre-pandemic levels, which most experts who study this sector thought we'd never see again, ever, that maybe at best we'd get back to 60 or 70% of pre-pandemic business travel. So that is a stunning revelation, just to reiterate that. And we've seen it across basically all companies in that travel sector. We've seen it across the cruise stocks. We saw it with Airbnb up 14%. We've seen Carnival's up 50% this year. So look, it is across the board. We also talked to the Okta CEO earlier today, and they said easily the biggest increase, the most popular downloaded apps they're seeing are in travel. With this quote from their paper, neither flight delays, high gas prices, hospitality worker shortages can keep us from going everywhere. And they also said the United States in particular, and they started this globally, is the biggest area of growth in the travel sector. It's just an appetite that cannot be quenched right now, or thirst, rather.
It's certainly stunning, these numbers. It is amazing. It's totally different than I think a lot of people had expected to see. When you go back a year ago, I think a lot of people thought that this recovery was going to be much slower. They didn't think we were going to be getting to that 90% level that we're hearing from Marriott. Another thing that stuck out to me, though, in this call yesterday was from CFO, some of the comments there from Leanie Oberg saying that the travel there is rebounding in terms of corporate travel faster among small businesses than what they're seeing from larger businesses. So smaller businesses are sending their employees on the road a little bit quicker, a little bit more than what we're seeing from larger businesses. So just an interesting tidbit that I wanted to point out here. And then just in terms of the demand that we're seeing, despite these cost-cutting efforts, they're saying that demand here for corporate travel is carrying into this year. So.
And you look at the center of all this is probably Las Vegas. That's where most of the work conventions still are today. And you've seen Vegas report 120% increase of flight traffic from pre-pandemic levels. Another stunning stat. I will mention, though, Evercore did cut from outperform to hold the Marriott stock. So that was one who said most of this is actually priced in. So we also want to talk about Tesla shares rising again today and now up more than 70% on the year. Today's boost coming from a Barclays note, the firm initiating coverage on Tesla with an overweight rating and a $275 price target. Senior autos reporter Praz Romanian here with us now. Praz, what's the case here from Barclays on Tesla?
I mean, they're basically saying that, initiating here, Tesla stands out above all the picks in the auto space, which is kind of a big call, I think, from their point of view. Talking about how there's two clocks, a two-clock framework, right? So there's the first clock, which is the near term, that's cyclical, the economy, spending on inventory and cars and parts, things like that. And then the far term, which is secular changes, the big transformation in EVs, the huge sort of rollout, how much it's going to cost, how the society changes, right? So Dan Levy, the analyst there, says that Tesla is well positioned in both worlds, right? From a cash point of view, they have a huge cash war chest that they built up over the years. They're able to spend on their new cars there. And then also from a long-term kind of their EV and software prowess, they have sort of the ability to, they're the only company that's been mass-produced EVs, right? Like on a huge scale. And they have the sort of the software kind of backbone that they've been developing for many years. So those are two kind of bull cases for Tesla right here, right now. Just real quick, Ford and GM, equal weight. He likes them both. He likes GM a bit more than Ford because of their kind of progress on EVs, execution, and the AV cruise technology.
That really surprised me. Now, we saw a bad quarter from Ford, but they really came out of the gate so strong in the EV space, in particular with the Ford F-150. To hear Barclays choose GM over Ford in that space was a big surprise. Was it something beyond the production issues we've heard of?
I think it's because, and I didn't see this in the note, but I think it's because GM has their sort of rollout with the Ultium platform that you can make multiple cars off of, whereas the Mustang Mach-E, the Lightning all use different platforms. It costs more money to develop these things. You have one-off sort of platforms lying around. It's easier to kind of use one and then scale it to multiple different cars.
When is that Silverado out?
This year, mid this year. And the cheaper one will come out later this year too. So mid this year, the
Excited about that one?
I really want to see more and learn more about it. You know, I love the F-150 Light.
You do love the F-150. What also struck me about this note was a call here that we're seeing on Rivian. Lots of questions about what the future of Rivian looks like. They actually said that it might be best positioned here just in terms of following in Tesla's footsteps, which we're seeing that reflected in the stock price today.
Yeah, a really nice move for Rivian today. I mean, almost 9% there. Talking about how Rivian sort of they don't want to say that they're the next Tesla, but they're sort of the only pure play EV that could possibly be the next Tesla because of the fact that they have like sort of a moat there with their products, right? Like no one else is making adventure vehicles. They have their own sort of technology. They're really kind of cornering the market in that space, and they're pure play EV. So that's sort of what Dan is saying. Levy's saying that this is sort of the best positioned automaker to be the next Tesla, not that they're saying that they might be the next Tesla.
I love these cars. I'm seeing more of them than I ever thought I would. But what is that moat? What is that unique technology that Rivian has that others don't have?
Well, I think it comes down to the fact that it's both product and tech, right? So from a product point of view, there's no other EV pickup or SUV with 4 motors on each corner. They have their own software. They use different components, different suppliers to make their batteries and their motors, but they're also kind of bespoke to them, right? And they're kind of cornering that market. It's not a work truck, it's an adventure truck. And I think also from a technology point of view, they have a lot of cool little features like the gear tunnel in the truck. Like I said, the 4 motors at each wheel kind of give you like pure, they call it torque vectoring on each. I mean, this is all nerdy stuff, but it's really
Did you
cool
drive
stuff.
one? Have you driven one?
Yes, we reviewed one. I thought it was incredible. It drives like a sports car, but it can kind of go over loose gravel, rocks, like floating over the ground.
Shares loved it. Investors loved it. Up 8% today on this news.
All right, Pross, thanks so much. We need to get to Cisco earnings. That stock on the move here following its earnings release. You're looking at shares jumping up 8% here in extended trading. Hallie, what do we have?
Yeah, that's right. We had revenue of $13.6 billion. That's versus expectations of $13.4 billion. So a beat there on the top line and a beat on the bottom line. Adjusted EPS came in at 88 cents a share. We were expecting 85 cents a share. And just to give you an idea of where we were last year this time, they were at $12.7 billion revenue in Q2 2022 and 84 cents a share back then as well. So a big jump over the prior year. I think part of the reason why we're seeing this big jump as far as shares right now is because of the Q3 estimates. They're estimating between 96 cents and 98 cents a share in Q3. The consensus was for 89 cents. So big beat there. And then as far as revenue, they're expecting it to jump 11 to 13% next quarter. Wall Street figured it was only going to jump 5.8%. This is clearly on the strength of a number of their offerings, whether that's networking or security. And right now, this seems to be a company that really is doing quite well, despite the larger backdrop when you look at things like cloud services from the likes of Microsoft, Google, Amazon kind of falling a little bit. We have Cisco here doing very, very well.
Yeah, certainly that revenue guidance number really signaling here that corporate tech spending remains solid. One of the big question marks going into this report. Dan Halley, thanks so much. After the break, we're going to dive deeper into Cisco's earnings. Again, the stock up just about 7% in extended trading. We'll be right back. Cisco shares jumping just about 7% following its fiscal second quarter earnings. The company reporting a beat on both the top and bottom lines. Guidance, though, for revenue, one of the key drivers here for this after hours move here in the stock. Guidance for its third quarter revenue coming in better than expected. Also full year revenue growth of 9 to 10.5%, beating the street's expectations by a wide margin. For more on that, we want to bring in William Kerwin, Morningstar equity analyst in technology. William, it's great to have you here. So clearly strong numbers here from Cisco. The guidance looks pretty solid as well. Your first reaction?
Yeah, it's absolutely a story of the better guidance. You know, results in the fiscal second quarter came in a little above our expectations, a little bit above consensus, but that guidance for the third quarter, especially on the top line, a midpoint of 12% year-over-year growth, that's well ahead of our expectations coming into this release at about 6%. So it clearly implies an acceleration in the second half. And I would just say, stepping back for a second, it really shows that the networking market in general is proven to be a little bit more resilient this year amid a backdrop of some weakening end markets elsewhere. So definitely positive for Cisco.
CEO Chuck Robbins saying as part of the release, the modern, highly secure networks we are building serve as the backbone of our customers' technology strategy. This, combined with the success of our ongoing business transformation and operational discipline, gives me confidence in our future. How might the China reopening story play into their future as well?
It definitely plays a role, as one aspect of the overall demand. But when we look at Cisco, we really see it as a diversified story in terms of its end customers, its end markets. We still believe that the core networking business really drives results, and that's what the CEO was referencing there in that comment. But they also have the cybersecurity business, the collaboration businesses. Though, upon first glance at the press release, it really does look like that core networking business is what drove the beat this quarter and the impressive guidance next quarter. So China is a factor. I wouldn't say it's the primary driver in our view, but they have a diversified amount of drivers that all look to be going really well for them.
William, supply issues had certainly been a challenge here for Cisco recently. We know a number of shortages for their components had held back their ability to fill all of their orders. In this release, the company saying that they have taken steps to improve supply. What do you think the supply picture currently looks like, and how much improvement are you expecting in the coming quarters?
It's definitely something where we're not back to a period where all the supply constraints are alleviated, but it's something that we expect to slowly work its way back to normal throughout calendar 2023 and probably last a little bit longer. So on the prior call, Cisco, this is the second quarter in a row that Cisco has raised its full year guidance. So very positive for investors there. But on the previous call, they had talked about expecting a step function each quarter of alleviation of the increased costs related to those supply constraints. And so it appears that they're sticking to that message and potentially that it's improving even a little bit faster than they expected just 3 months ago.
We see software subscription revenue up 15% year over year. And you say it has essentially a wide moat, which speaks to their competitive advantage. If there's one thing that really encapsulates that advantage over their competitors, what is it?
For us, it's definitely looking at Cisco's portfolio from her holistic perspective. We like to talk about it as a walled garden sort of approach, where they get into customers serving their core networking hardware needs, but then on top of that, they layer networking software. They can layer cybersecurity software, collaboration, and it really creates a broad-based value proposition where they embed themselves in various touch points of those customers that makes them hard to rip out. So our wide moat rating coming into this quarter is really based around those customer switching costs and just being embedded in mission critical workflows in those enterprise organizations.
All right, William Kerwin, Morningstar equity analyst. Thanks so much for joining us again. Cisco Systems, that stock up just about 6.5%. For more on Cisco's earnings, be sure to tune in to Yahoo Finance Live tomorrow morning. Cisco CFO Scott Herren, he will join the live programming, talk to us about these results, also what's in store for the company this year. Dave?
Shopify out with earnings now. Inez Ferre has the numbers. As you can see, shares down a little over 3% in extended hours. Inez, what are we seeing?
Yeah, Dave, well, it was a beat on the top and the bottom line with the e-commerce tech company's revenue coming in at $1.73 billion. The street was expecting $1.65 billion. Adjusted earnings per share came in at 7 cents. The street was expecting a loss per share of 2.5 cents. Fourth quarter gross merchandise volume that came in at $61.0 billion versus $59.21 billion that the street had been expecting. Some commentary from Shopify's president, Harley Finkelstein. He said in a press release, Shopify launched several new key strategic products in 2022, and we're excited about the potential for them to help our merchants succeed. Now, you'll recall that last quarter, Shopify placed in a new CFO. It cut jobs early when tech companies were cutting jobs. It cut jobs early last year. It also, this year, increased prices on its merchants. So year to date, the stock is up 45%. Last year, the stock had gotten hammered. Right now, we're seeing it slightly lower in after hours, guys.
Interesting to see a beat on the top and the bottom and some positive commentary and shares falling. Inez Ferre, thanks so much. Coming up, we'll take a closer look at Shopify's fourth quarter earnings. Stay with us.
Shopify shares falling here, off just about 4% despite its most recent earnings report, where the company beat on both the top and bottom lines. Revenue $1.73 billion, adjusted EPS of 7 cents. Let's talk about these results with Gil Luria, D.A. Davidson Managing Director. Gil, it's great to see you here. So quick first glance here at these numbers. They look decent compared to what we're expected to see on the street, yet we're seeing the stock fall in after-hours trading. Why?
It's one of those situations where the expectations were even higher, especially for guides. The results for the quarter itself are very good. They grew a lot faster than we thought, and they're more profitable. And that's before the price increases that they took are incorporated into their numbers. So in terms of 2022, they ended that very well. In terms of 2023, their guidance for high teen revenue growth was probably a little less than investors expected, given that they are taking these big price increases right now. Yeah, those price increases are, to your point, massive, 33%. How sticky is that service? How much do you think it will propel their Q1 numbers? It's very sticky. Their Shopify merchants really love the product. They love using it. It's not a big part of their spend. So spending a third more than a small number for them is not going to be the factor that gets them to switch away from Shopify, especially since most of them buy multiple services from Shopify. Not all of those prices have gone up. So I don't actually think that they're going to have much attrition from these price increases, which shows you how important they are to their merchants.
Wow. Okay, when you take into account the growth that we're expected to see in the e-commerce segment here, clearly Shopify well positioned. Do you think that they are actually in a position to outgrow the e-commerce market? And what does that exactly look like?
They have been, and it looks like they're in a very good position to continue to do so. And that's because they're part of what's driving the democratization of online retail. It used to be that the best way you could sell was through Amazon or through another marketplace like Walmart or eBay. And what Shopify has made it possible is for all these merchants to sell directly to their customer, to own the relationship and do so relatively easily and at a relatively low price. So they have been growing faster than e-commerce. We'd expect that to continue. Yeah, and they do have competitors, many of them, coming for them. What is their competitive advantage in that sector? They have a large head start. They're bigger than the next size competitor by a factor, excluding obviously Amazon, which is both a competitor and a partner. They're much bigger than the next size competitor. And again, they provide more services. Their prices are not that different than the next size competitor. And because they have the multiple services, it's harder to switch away once a merchant starts with Shopify. But that's to say there's such a dynamic ecosystem. And to your point earlier, there's a lot of e-commerce growth. A lot of other providers are going to be able to succeed here. It's just that there's no reason to think Shopify is going to lose share to any of them.
When you take a look at some of the moves that Shopify has made, they named a new CFO back in September. We've already seen the price hikes, one of those initiatives under the new CFO. We also heard about layoffs. That was several months ago, one of the first tech companies really to announce layoffs. Do you see those cost-cutting measures carrying into this year? And if so, what do you think we could see then from Shopify as the focus really does become more focused on profitability?
Yeah, it looks like their guidance for this year is for operating expense and gross and COGS to grow slower than revenue. So it looks like those cost cuts are translating into their outlook. Their profitability dipped quite a bit last year, so it makes sense that that would happen. And they didn't need to show discipline once that happened. They'd been profitable really since inception. Last year was an aberration. They needed to get that discipline back, and they're showing that in their outlook for this year. All right, Gil Luria, D.A. Davidson, good to see you, sir. Thanks so much. Okay, shares of Chipotle trading, let's see, just about level on the day. A little bit of movement. The burrito chain announcing a new restaurant concept called Farmesa. Brooke DePalma is here with the details. This is not something we have come to expect from Chipotle.
Right, expect it or not, it's a farm-to-table approach that they're looking to start here. So mesa is the Spanish word for table, and so it's a combo for mesa. And as you can note here that this is a new concept by Chipotle. It's in partnership with a ghost kitchen located in Santa Monica, California. It's set to open next month. The ghost kitchen is Kitchen United Mix. Now it's entirely digital, so guests can order via kiosk on Kitchen United Mix's website for pickup or delivery through apps like DoorDash and Uber Eats. Now this comes as Chipotle bets big on digital. In their latest quarterly results, digital sales did account for 37.4% of total food and beverage revenue, that is. But this menu, curated by a James Beard award-winning chef who previously worked with Chipotle in years past. He will stay on the team at Farm Mesa for the interim time here. Now, it is a Chipotle-style model. As you can see there, it has a choice of protein like steak and salmon, greens or grain, 2 sides, and a choice of 5 sauces as well as a topping. Now, as far as the price point for these bowls, they'll range from $11.95 to $16.95. It also has beverage offerings with a previous partnership that's also with Chipotle called Tractor Beverage Company. So it definitely does cater to a bit of a higher end audience, of course, in Santa Monica, and we're looking upwards of $17 for one of these bowls.
Well, the video that we're showing, they have me
It
on
looks
board.
pretty
It
good.
looks very, very good.
Either that or we're all hungry, but it does look good.
Well done, Mr. Nickel.
Yeah, exactly. We didn't see much of reaction, though, in the stock today. We're excited about it. Is the street excited about it?
Yeah, well, I did speak to a few analysts on the street today, and Sean Dunlap of Morningstar specifically noting that Chipotle has a ton of free cash flow sitting here to accelerate development underneath their umbrella. Of course, they've tried concepts in the past, but this concept has a similar chain with similar local suppliers, it looks like. So overall, the hit to Chipotle's bottom line here, he says it's actually pretty minimal. So there won't be a huge hit should the concept take off or not. But Citi analyst John Tower agreeing there. He said in a note on Chipotle's Farm Mesa on potential expansion, quote unquote, while one location does not beget a chain, we think the Farmesa Fresh Eatery brand does signal the company sees an opportunity to grow beyond its core concept, utilizing many of attributes of the Chipotle brand, like that simple menu, like food integrity with its real quote unquote ingredients, as well as the easy operation, that sort of chain.
Sure.
But the potential customer here it's very niche here, meaning a limited addressable market. It's a health conscious consumer. Also, it's a higher price point consumer. And like I said, Chipotle's dabbled in this before, this sort of testing out what's going. It had Shop House, which closed in 2017, Tasty Made closed in 2018, and then Pizzeria Locale, they acquired that. You probably never heard of it.
I don't remember any of those.
But it's only in Denver now, so they closed those out. And so still active, but not as active as they once were. So we'll see if this one takes off. It's currently just in testing, it seems like.
You can't help but wonder if there's some cannibalization there because they've seen a real influx of people above $100,000. So those are the same types of customers they're trying to get in Chipotle.
Yeah.
Be interesting if they see any of that.
Right, you're looking at like a Sweet Green customer, a Flower Child customer there. So definitely a particular market that's doing well in this economy.
I'm so hungry. Brooke, thank you, I think. But now I'm just more hungry. Coming up, one family saga being described as the real-life version of Succession takes center stage. We dive into a new book covering the Redstone family saga with author and New York Times columnist James Stewart. You don't want to miss this story. Stick around. Paramount Global will step into the spotlight tomorrow before the bell when it reports its fourth quarter earnings. Investors appearing bullish during today's session, with shares ending the day, as you can see, up more than 9%. But earnings aren't the only reason Paramount is seeing more attention. A new book titled Unscripted: The Epic Battle for a Media Empire and the Redstone Family Legacy hit shelves yesterday and takes a deep dive into the behind-the-scenes drama that threatened the future of Paramount Global. One of the book's authors and New York Times columnist James Stewart joins us now alongside Allie. Good to see you, Allie.
Yes.
This is such an
excited
incredible story.
It's incredible.
I mean, it is just, it's delicious. Let's start with the focus, Sumner Redstone. For those that aren't really familiar with the story, sir, how would you describe him in a minute or two?
Well, Sumner Redstone at his peak was one of the most, if not the most powerful media mogul in the world. He was maybe, I won't say the last, we still have the Murdochs out there, but he's late in a long line of extremely powerful media executives. And he built this company from 2 drive-in theaters outside of Boston. So into a multi-billion-dollar company that owned CBS, Paramount, the Viacom channels, MTV, Comedy Central, Nickelodeon, you name it. It was a very big and powerful media empire.
But that makes him sound like almost an admirable figure, not the guy I'm reading about here. Tell me about the other side.
Well, he was brilliant and he was competitive, and he was, look, I'm not a psychologist, but he had so many insecurities, so many bizarre personal qualities. His, insatiable competitive streak against even his own children. He drove them both away at various points. His insatiable appetite for sex, for young women, for throwing money at them is like nothing I've ever encountered or experienced, nor did I ever think I would be writing. But I think somebody said this is a business book that made me blush. And I was thinking, whatever, these are the facts.
Yeah, and clearly, as you write about in the book, this company has dealt with a lot of mismanagement. But Sherry Redstone, she has doubled down that the leadership team that Paramount has today is as strong as it could ever be. 1, do you agree with that? And 2, does it even matter? Is this company too behind in the streaming wars at this point?
Well, I think Sherry deserves a lot of credit. I mean, as you see in the story, she overcame one obstacle after another to take control of this, to merge the 2 companies. I think almost everyone agrees that made sense, that Viacom and CBS, now Paramount Global, needed greater scale. They probably need even greater scale than they have, but they needed it. They probably needed it sooner. And so she was right to do that. She hired a new chief executive after, Sumner was, blind to the faults of Philippe Domont, Viacom, Les Moonves at CBS. I mean, he let them run it as they saw fit, which of course is why they didn't want to give it up. But they now have Bob Bakish there. And, I have to give her credit. The stock collapsed along with most of the streaming companies. It's been coming back, but they have some real hits. They've got Yellowstone. They had Top Gun, Maverick, which was a mega hit this summer. So there's a lot of good stuff happening there. But I think, it's a scale business. The companies are spending billions on content. You've got to amortize that over a large subscriber base. The bigger, the better. And they're running up against, Amazon, Netflix, Disney Plus, and they're in a second or third tier compared to that.
So with that, where do you think Paramount goes from here, especially in terms of M&A? We saw Warren Buffett up his stake in the company today. We got that news. Could he be a potential buyer? Are there other buyers out there? Where do you see this going?
Well, I think it has to go with someone bigger, I think. And, it is interesting. They do have what Sumner Redstone always considered his crown jewel, which is the Paramount studio. Netflix, for example, does not own a studio. Amazon bought MGM. Disney obviously has the Disney studio. That would seem to be a kind of obvious pairing if it could get by the regulators, which is a big if. I think a big obstacle is that the stock price was so depressed. It got down to $15. And Sherry, if effectively the controlling shareholder, is not going to sell to anyone at that price. But she has said repeatedly to many people that she would sell it at the right price. She's not determined to cling to mogul status no matter what.
The Sumner I read about in Unscripted is I'm just going to say, despicable and loathsome character. Do those around him, did they feel any love? Did they feel any respect for him, or neither?
Well, he was pretty much surrounded by a crowd of grifters, in my opinion. Some of them were the women, some of them were the professionals, the lawyers, the advisors. I think one of the shocking things here is that someone that rich, a billionaire many times over, you would think would have guardrails, that would have the highest level professionals protecting him. And yet, these women were able to move into his mansion and virtually take control of his life, not to mention his bank accounts, his trust accounts, his will. They made off with over $150 million. In one afternoon, he wired them $90 million. And who's there to protect him? I think it's an appalling failure.
Wow, it's an incredible read. Pivoting to today's media landscape, is there any common thread between this story and Rupert Murdoch and the succession there, and News Corp and the merger, which has now been called off?
Well, this book has been compared to the TV series Succession, and having been watching it, and I love it, it is clearly an amalgam of material taken from the Murdoch family, some taken from Sumner Redstone. But for some reason, in these big media companies, and particularly, succession is a huge issue. I mean, it's cropped up at Disney just recently. Look, they got rid of the chief executive. They had to bring Iger back. The Murdoch family is struggling to figure out how to do that. The unbelievable battle that went on here at Paramount and Global. There does seem to be something about the spotlight that is on these media companies, and maybe it's just the sheer, the glamour, the power, the fun, whatever people think it is, that nobody wants to give these up once they're in the leadership positions. On the other hand, if you think running one of these companies is going to make you happy, or making the billions that Sumner Redstone did, this is a case study in how immense wealth does not bring happiness or peace of mind. No.
Yeah, and you mentioned Disney and Bob Iger. What do you think will be key in that succession plan in order for it to not go horribly wrong like the last time?
Well, he said he's leaving in 2 years.
Yeah.
And
Allegedly.
Allegedly.
We'll see.
And I have to say that I don't know that there are many people that take that strictly at face value, because it's 2 years isn't very long. And that's a massive company. If he hadn't groomed a successor before, it may take longer than 2 years. There are some talented people working there, but no obvious candidate to step in as soon as 2 years. And I tip my hat to Iger. He's a master of communication. Wall Street loves him. Already the stock has gone up quite a bit. He managed to stand down the latest proxy challenge from Nelson Peltz. So it'll be really interesting to see what he can do there. But again, Disney, Paramount Global, even Netflix and Amazon, they're all facing the same fundamental issues, which is streaming so far has not proven to be a profitable business, except for the people making the streaming content.
Yeah, it's a difficult road. So he says he's going to Iger stay 2 years. Elon Musk now says he's going to stay at least through the end of this year at Twitter. He sat with Rupert Murdoch at the Super Bowl, if there's a common thread there. How do you think that story plays itself out at Twitter? And does anyone want to work for Elon?
Well, I will say this for Elon at Twitter. At least it has calmed down after the unbelievable chaos that was, running rampant there. I just, look, I'm not going to count Musk out. The previous formula was not really working there, and although he's taken some really drastic measures, chopping the personnel, he is getting the cost down. The advertisers have fled, but will they come back? I wouldn't want to bet against him.
And you hear that a lot. He's done pretty well with Tesla and with SpaceX and most other things he's touched. Ali Canal, thank you. James Stewart, the book is Unscripted. Check it out. Some incredible storytelling. Great to see you, sir. Thank you.
Thank you.
All right, coming up, Tesla investor Ross Gerber is pursuing a board seat at the EV giant Tesla. He tells us what he plans to do if he succeeds. And Adidas is warning investors about the financial hit it could take from losing Kanye West's line. Here's Josh Schaefer.
Adidas says it could stand to lose more than $1 billion in revenue after cutting ties with Ye, the rapper formerly known as Kanye West. Here's what you need to know. Adidas severed its relationship with Ye back in October after the rapper made several public anti-Semitic comments. Now Adidas is left with loads of the rapper's Yeezy branded merchandise that could be worth more than $1 billion in revenue. If Adidas walks away from the merchandise altogether and doesn't sell it, it could lose up to $750 million in profits and post its first unprofitable year in more than 3 decades, according to the Financial Times. When thinking about this, it's important to understand what Adidas was trying to do with Ye and how powerful one person can be for a brand. Take Michael Jordan, for instance. Nike signed the NBA player back in 1984, and remakes of his Air Jordan 1s are still one of the best-selling models in sneaker culture. In 2022 alone, Nike sold more than $5 billion worth of Jordan brand product. But leveraging one massive brand on one prominent man isn't always the right path. Adidas Yeezy collection has grown increasingly popular since it launched in 2015 with Yeezy Initial Boost 350, the Yeezy Slide, the Yeezy Foam Runner, all growing in popularity. But now Adidas is stuck with all those shoes and is unsure about selling them, raising a larger question in today's retail environment about whether brands should be just as worried about what their ambassadors say as what they wear.
Longtime Tesla bull and investor Ross Gerber is pushing for a board seat, sending a letter to the EV maker's general counsel this week. Ross Gerber, CEO of Gerber Kawasaki Wealth and Investment Management, is here to discuss. Ross, it's great to have you here. Lots to get into. You have certainly been a vocal critic of Elon Musk, the CEO of Tesla now, for some time. You are now pursuing a board seat. If you get it, what do you want to change about Tesla?
Well, I think the biggest thing is the whole perception that advertising should only exist on Twitter or through tweets, I think is a very, short-sighted view of where Tesla is going as a company, as a global brand. I think it's important that Tesla expand its PR and marketing and communications team, as well as lobbying efforts. When you have NHTSA looking to shut down full self-driving, it's time for Tesla really to, step up and they make these great videos and they post them on Twitter, but 95% or more of people don't look at Twitter. So, there's kind of an echo chamber there. And I think the perception is different than the reality out in the real world, where I think Tesla messaging needs to get out better. And then secondly, they need to focus on service and the consumer. There's so many Tesla customers that tell me bad stories about service, and it's time for them to really take a focus on customer service. And we're going to have competitors over the next couple of years for the first time ever. And so it's important that Tesla continues to maintain its edge. And then thirdly, a succession plan. Now it's become clear that Elon isn't coming back to full time to Tesla anytime soon as he continues to be CEO of Twitter. What is the succession plan? Who is really running Tesla on a day-to-day level? And if something, God forbid, ever happened to Elon, what would happen? And so those are the main things I'm really focused on and trying to get answers from the company, because I really think it's time for Tesla to, I've been saying, grow up and become a brand like Apple, where people all around the world will know Tesla for being Tesla.
So, Ross, good to see you. Is Tesla fully autonomous? Who is driving Tesla currently? And what is your reaction to that news that Elon will stay on at Twitter through at least the end of this year?
Well, I was extremely disappointed to hear that news. He kind of promised that he would give up being CEO, and I expected it to be sort of a short-term thing. And, now that he's going to be focused on Twitter for the whole year, it certainly brings in concern to me as far as it's such a just crucial year for Tesla. And I'd love to have more clarity of who's responsible for execution of all the different parts of the business plan at Tesla, which I haven't gotten yet. So I'm hoping to get more clarity, and I think that'd be great. But I think the other issue is also just, the brand is, in my mind, iconic like Apple, and it needs to start thinking like Apple and building its global brand through other forms of marketing.
Ross, have you heard from Musk or anyone at Tesla?
Not yet. I mean, we just sent the letter yesterday, so it's brand new. I haven't heard anything. We spoke on this Spaces where, he promised certain things and he insisted that he was, not missing any of his responsibilities at Tesla, which, I'm sure that's true. But the bottom line is running a company like Tesla and being CEO of Tesla is a full-time job. And I don't think Elon's lifestyle is sustainable currently, and I'm pretty concerned about him, to be honest. I'm a huge fan and a huge supporter of Tesla, and I just want to see what's best for Tesla and the company, as well as having a sustainable future for Elon as well. He's got a lot on his plate by anybody's standard.
Sounds like you're a concerned friend there almost. Why are you concerned about his lifestyle, which you called what is unsustainable about it? When was the last time you guys spoke?
Well, we spoke on the Twitter Spaces in December, and look, we're all human beings and working 7 days a week from 9 a.m. to 3 a.m. is just, he's done it in the past, but it's just not a sustainable lifestyle. I am concerned. He's the same age as I am. I'm 52. It just turned, and I'm working out. I'm actually in the best shape of my life, and it's a really big goal of mine to make it as long as possible. But if we're going to get to Mars and we're going to do that, we need Elon to make it another 20 years at least. So yeah, I'm a friendly activist. I'm a huge supporter of Elon and the company, and I just want to see a future for not only Tesla but also for Elon that we'll all be here for. And once again, I was a big investor in Apple during the days of Steve Jobs, and unfortunately he passed very prematurely and very unexpectedly. So I have had experiences that make me concerned about the future.
Ross, you're in the best shape of your life. I wish I could say that about myself as well. I'm far from it, to be totally honest. But Ross, let's talk a little bit more about succession, because I think a lot of people are wondering that at Tesla, just in terms of what that company could potentially look like here down the road. Do you have anyone in mind, or anyone maybe that you have spoken to that you think would make sense in terms of succeeding Elon Musk?
Well, ideally, I would just want Elon really refocus back 100% on Tesla. But assuming that, I think that's what I'm trying to figure out from management now is what is the org chart at Tesla? Who reports to who? Like on a day-to-day basis, obviously decisions are being made, whether it be in Austin, Berlin. And I think that clarity of who's really behind Elon would serve investors and the company well. And I think it's time to really build another set of leaders for Tesla, and they certainly need, some sort of number two, I think, like a Tim Cook. But we've seen good examples of succession planning with Netflix, and we've seen a bad, succession plan with Disney, where now Iger has come back and trying to redo it. So this is not a simple thing, and that's why it's so important for the company to be focusing on this.
All right, Ross Gerber, please come back when you do have a response. We'd love to discuss further. Good to see you, man.
Yeah, I'll let you know. Thanks for having me.
All right, best of luck. Coming up, Cisco and Shopify aren't the only companies making moves in after-hours trading. We'll fill you in on the rest next.
Couple of movers here after hours. A lot of it has to do with earnings. Let's get to it. We have Roku, Zillow, Twilio, and Boston Beer. Kicking it off with Roku. You're looking at that stock popping here after hours, up just about 11%. Strong numbers from the company. Revenue topping expectations, coming in $867.1 million. That was better than what the street was looking for. They also added 4.6 million new users during its latest quarter. Obviously, that's a huge growth here, much higher than what the street was looking for. That's why we're seeing the stock push to the upside here after hours. Over the last 3 months, we're looking at gains of just about 7.5%. Over the past year, though, you can see that serious decline, off just about 62%, closing out today 63.49. Let's take a look at Zillow Group. That stock also on the move after hours, up just about 1% right now. What's popping a little bit more here just a few moments ago. Sales beating the street's expectations, 435 million. More rental listings boosting sales during the most recent quarter. Fourth quarter visits totaling 2.2 billion on its site. The company also saying that it did cut 2,000 employees in total last year. Over the last 3 months, the gains have been just about 25% over the last year. You're looking at Zillow stock off about 27%. But again, a move to the upside here, up just about 1.5% after their sales beat the street's expectations. Looking at Twilio here, that stock up just about 12%. Another big move here after hours. First quarter earnings guidance coming in better than expected. Revenue of just about $1 billion. That beat the street's expectations by 20 million. The company also authorizing a $1 billion buyback here. We know Twilio also recently announcing another round of layoffs, cost-cutting measures, very important here for this company in the new year. You're looking at a 3-month gain of just about 22% over the last year. Twilio has certainly taken a huge hit, as many of its competitors have as well, with the shares off just about 67%. And taking a look at Boston Beer, that stock off about 11% in extended trading, moving to the downside here. Revenue did come in better than expected. Silver lining there, up about 28% on a year-over-year basis, but that wider than expected loss is why we're seeing so much pressure on the stock here after hours. They posted a loss of 93 cents. The estimate was for 62 cents in this earnings release. The company saying that near-term trends remain challenging because of that hard seltzer category. Certainly has been a challenge here for Boston Beer in the last couple of quarters, as we have seen sales really hold pretty steady here. They're stagnant in that division, even decline in some cases. But again, the stock off just about 11%. It's a tough road here, at least for now.
Yeah, it really is. And moving forward, they anticipate another net loss for the first quarter of 23. The beer sector is just a tough one right now. The only real growth we're seeing is actually in the non-alcoholic category, which they are not in. You mentioned hard seltzer struggling. They do say in the release, Twisted Tea continues to experience industry-leading double-digit growth. They do have that. They're going to need another category, and it might be a cannabis beverage moving forward.
It might be.
It might be a non-alcoholic.
Yeah, Twisted Tea. I was going to say, I wish we had time to put the picture of you holding the Twisted Tea, posing at the Garden.
I think it
was
helping sales. I think it was $17.50 at the Garden.
Wow.
Ouch. Shauna,
fair to say you overpaid.
That'll do it for Yahoo Finance Live today. Be sure to come back tomorrow, 3 o'clock Eastern Time. All your coverage leading up to and after the closing bell.